Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner. Welcome to the show today. We're going to talk about taxes today. Tax season is coming up. It's early in the year, and we're probably starting to think about taxes. The biggest mistakes made during tax season are what we're going to talk about. These are things that can trigger IRS audits. So we're going to talk about the top 10. Again, not an exhaustive list, but definitely some of the top things that can trigger audits, which we want to avoid. So tax season can be stressful, especially if you're worried about making a mistake that might attract unwanted attention from the IRS. So most people, I think, make their best effort to file accurate returns, but some things that are common errors can lead to audits, penalties, or unexpected tax bills. The good news is you can avoid these if you know what to look out for. So let's dig into the top things or top mistakes made during tax season that can trigger IRS audits. So number one, simple typos and input errors. So believe it or not, a little typo like transposing numbers, mismatching social security details, or claiming a dependent incorrectly is one of the top reasons for IRS notices and audits. The IRS matches information from your tax return to what's reported by employers, banks, and other institutions. So if something doesn't match up, it can cause problems. So you can avoid this by double checking all information you input, including social security numbers and income figures. And then if you use a tax preparer, be sure you review the return carefully before signing off on it. So make sure that you review your own tax return. Number two, forgetting to report all income. So missing or unreported income is another common trigger for IRS scrutiny. Income from part-time jobs, freelance gigs, rental properties, all that stuff matters. Even cash payments. So the IRS receives copies of your W-2, your 1099s, and other income statements. So if you don't include those, they're accurate, or their automated systems might know that it's inaccurate in terms of matching up, and the system's going to flag it. So what can you do to make sure you avoid this? Make a checklist of all income sources. Include side gigs, freelance work, investments, everything. Check your mail and your email for all income-related forms, things like W-2s and 1099s especially. A lot can be coming at you during tax season, so check everything. If you're not sure of what income the IRS has on file, you can request a wage and income transcript directly from the IRS, and that can help you kind of see what to expect. All right, number three, using rounded or estimated numbers. So expenses that are perfectly rounded, for example, $5,000 for travel or $10,000 for supplies, those can be red flags for the IRS. So real expenses typically don't come in nice round numbers, and so a round number can look suspicious. So for example, if you report a Schedule C business with neatly rounded numbers across every category of expenses, the IRS might think you're estimating or inflating those numbers. So how do you avoid this? Always use exact amounts based on receipts and bank statements, and keep records of your expenses to back up the numbers on your return. So again, make sure you keep all those receipts, keep all those invoices, be able to back that up. All right, number four, claiming non-cash charitable contributions without proper documentation. So donating non-cash items like furniture, artwork, or real estate, it's a great way to give back, and you can claim a tax deduction for it. But there are rules, and if you don't follow the rules, your deduction could be denied. So here's the rules. For donations over $500, you need to complete Form 8283. And for donations over $5,000, you need a qualified appraisal. So without this documentation, the IRS can disallow the entire deduction, even if the donation had real value. So another note is if the amount is over $5,000 but less than $500,000, the appraisal has to be obtained but not necessarily attached to the tax return. If it's over $500,000, you need to attach the appraisal to the tax return. So always get written acknowledgement from the charity to prove that it actually happened. And then for donations over $5,000, hire a qualified appraiser. Number five, turning a hobby into a business, a quote business. This is in quotes. If you claim losses year after year for a side business, the IRS might decide it's really just a hobby. Under IRS rules, you can only deduct business losses if you're running the activity with the intent to make a profit. So the IRS assumes an activity is a hobby if it hasn't turned a profit in 3 out of the last 5 years or 2 out of 7 years for horse breeding. So to prove it's a business, Be sure you keep separate bank accounts for the business and separate records for the business. Treat it like a business, like its own entity. Document your efforts to make a profit. Things like marketing, consulting with experts, anything you've done to try to grow the business. Track your time and money spent on the activity, showing it's not just for fun. Be sure you track your time and show that you've put real time and effort into the business and you're trying to make money. Number 6, claiming ineligible dependents. So claiming a person as a dependent who does not meet the legal definition, or even just failing to include a dependent's valid social security number, can result in underpayment of tax and might trigger an audit. So make sure those dependents are qualified. Number 7, mismatch between gross receipts and sales tax returns. So if you run a small business, the IRS and state tax agencies compare your reported federal gross receipts to your state tax returns. If the numbers don't match, it can raise some questions. So for example, if your federal return shows $500,000 in gross receipts, but your state sales tax return reports $400,000, the state may assume you're underreporting sales tax. What you can do, you can review your sales tax filings alongside your federal return, make sure they match, make sure they align. Keep records that explain any deductions or non-taxable sales. Number 8, failing to disclose foreign accounts or digital assets. Foreign bank accounts and digital assets like Bitcoin, for example, are top priority for IRS enforcement. They're really cracking down on this. So if you don't disclose these things, there can be penalties. So foreign accounts is one example. If the total balance of your foreign accounts exceed $10,000 at any time during the year, you have to file what's called an FBAR, which is a report of foreign bank and financial accounts. So for digital assets, or virtual currency as it's sometimes called, again, like Bitcoin or crypto, if you own, buy, or sell these digital assets, you have to answer yes on the related question on your tax return and report any gains or losses. The IRS has really increased its focus on digital assets, including NFTs. So a taxpayer has to check yes on 1040 if they receive digital assets as a reward, an award, or compensation, or again, if you sold, exchanged, or otherwise disposed of digital assets. So report all foreign accounts and virtual currency activity and keep detailed records of transactions to calculate your gains, your losses, and balances accordingly. Number 9, not reviewing your return for accuracy. So many people rely on tax preparers or software to file their returns, but you're still responsible for its accuracy. If the IRS finds mistakes or missing information, you're on the hook for those penalties. You're the one responsible. So to protect yourself, review your return carefully before submitting it. Ask your tax preparer to explain any numbers you don't understand, and confirm that all forms like the W-2s and 1099s have been included during your tax prep. Number 10, filing incomplete or inaccurate return. So filing a return is incomplete, for example, missing a key form like a 1099 or K1, can cause problems. Some people file with placeholders and they plan to amend later, but this approach risks penalties and more scrutiny by the IRS. So it's better to file an extension if you're waiting on documents. It's better to submit an accurate return later than an incomplete return now. So keep that in mind. So the IRS is cracking down on mistakes, whether they're big or they're small. So accuracy is really important. So simple typos, missing income, unsupported deductions, or other errors can lead to those penalties, those frustration from potential audits. So protect yourself by double checking your return for accuracy. Report all your income, no matter how small it is. Avoid estimating or rounding numbers. Use accurate numbers for expenses in your business. Don't forget about qualified appraisals for non-cash donations over $5,000. Keep records to back up your deductions, your business activity, your foreign accounts, your crypto, all that. Stay organized and stay on top of it. So if you stay organized and you focus on these things and avoid these common errors, you can, in theory, file your return with confidence and avoid, frustrations and potential audits from the IRS. So keep that in mind during tax season. All right. So with that, always feel free to reach out. My website is elevationfinancial.com. You can find me there. You can send me a note through my website. You can find me on social media pretty much anywhere. Or if you want to consider becoming a client, you're welcome to book an appointment on my website, do a free consultation. Happy to answer any questions you have, and we can talk further. All right. So with that, thanks for joining me today. Have a great day. We'll see you next time.